Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at AusBiz. So let's check what happened overnight. Of course, in the wake of that drama we saw Monday globally with global tech stocks, they've rebounded a day after the low-cost Chinese AI model DeepSeek prompted investors to question the dominance of AI leaders and their suppliers. Wall Street's main indices finishing strongly, with the tech-heavy Nasdaq adding 2%. Both the Nasdaq and S&P 500 were dragged lower the previous session by Nvidia, with its shares falling 17%. That's close to $600 billion in market value wiped off the stock, a record one-day loss for any company. Its shares finishing almost 9% higher. The broader tech sector rose more than 2.5%. The Philly semiconductor index was flat after falling more than 9% on Monday. Now, while there are doubts over DeepSeek's low-cost claims, Sam Altman, chief executive of Microsoft-backed OpenAI, called the company an impressive model, saying we will obviously deliver much better models. And also, it's legit invigorating to have a new competitor, he said in a social media post. US President Donald Trump called it a wake-up call for our industries. Now, a number of big tech companies, including Apple and Microsoft, are due to report earnings this week, with investors now very much focused on capital spending for AI. Elsewhere, earnings highlights included Boeing, its shares rising despite the aircraft manufacturer reporting its biggest annual loss since 2020. The shares in General Motors fell heavily as investors considered the threat of tariffs, even as the car maker posted results and an earnings forecast ahead of expectations. Well, investors are now looking ahead to tomorrow's Federal Reserve policy meeting. The FOMC expected to keep its benchmark overnight interest rate at between 4.25% and 4.5%, while the US rate futures market has priced in 49 basis points in cuts this year. In the US economic data, durable goods, new orders there fell 2% last month to their lowest level since June. US consumer confidence also weakening, falling for a second straight month in January amid renewed concerns about the labour market and inflation. And US home prices rose 0.3% in November to be up 4.2% over 12 months. US Treasury yields have rallied, the 10-year rising more than 4 basis points to 4.57% after falling to a 4-week low, and the 2-year at 4.21%. And the US dollar has strengthened against the yen amid fresh tariff threats from the Trump administration, the Aussie falling to 62.5 US cents. And Bitcoin is trading around 101,000 US dollars. Commodities are mixed, oil prices having edged lower as concerns over disruption to Libyan oil loadings have eased, while fears of a weaker demand linked to softer economic data from China has pressured prices. Brent futures at close to $77 a barrel. Excuse me. Copper rising almost 0.5%. Iron ore little changed at $103 US dollars a tonne. And gold is up 0.8% to $2,764 an ounce as increasing uncertainty over President Trump's proposed tariffs prompted buying in the safe haven asset. So, as we mentioned there, a lot of movement on Wall Street all around those AI-related tech stocks. What are the implications? Well, I caught up earlier with Tim Richardson from Pengana.
What the market, has got concerned about is the increased efficiency that the AI model that's been delivered by DeepSeek is going to have on the demand for computing power, and therefore on the demand for the most advanced chips, which has got obvious implications for the earnings growth for some of those big companies. The thing we probably should remember is that the semiconductor industry is still very immature, so it's pretty unclear how that's going to evolve and where the threats to it are going to come from over time.
I mean, the question for investors, given the emergence of this supposedly low-cost model, is that they've over-capitalised essentially.
There's certainly been some huge sums invested. You saw the announcement from Meta just last week for the new AI data centers that it's going to. Stargate,
Yeah.
and Stargate as well. To what extent that's actually been financed is a little bit unclear. But there's clearly a lot of funds have gone into these projects. What remains really unclear, I think, is to what extent this greater efficiency is going to lead to lower demand for computing power and therefore the more advanced chips, or whether, as Jeevan's paradigm suggests, what you'll see is that the greater efficiency leads to lower unit costs, which in turn can actually increase the demand for computing power and bring a burst of energy into AI innovation.
Something that I know, particularly when we take a look at a company like Nvidia and likely demand, do you have a particular view of whether this has actually changed the outlook?
It remains to be seen to what extent it's going. This is going to impact the demand for computing power, and any analysis that comes up with a definitive answer should be treated with a fair degree of scepticism. But what you've seen is companies like Nvidia and Broadcom. They've grown their revenues and earnings and market capitalisation very, very quickly, and that's what has left them pretty vulnerable, to developments like we saw on Monday and over the weekend.
Tim, of course, we have seen very narrow leadership in the US, led by companies such as Nvidia. So, what are the broader implications, do you think, for the share market?
Well, I think looking first at looking at the tech sector, what we're likely to see is a shift along the value chain, something that was underway already. We're likely to see an acceleration of that shift from hardware to software. You see companies like Adobe, Salesforce, ServiceNow, that actually outperformed. We saw their share prices move up on Monday, and they moved up again yesterday. These are the businesses that are developing the applications that are going to drive the labour productivity and therefore the earnings growth of their enterprise customers, and they stand to really benefit if the development of AI becomes more efficient and more cheaper over time. And perhaps looking at beyond the technology sector, I think probably in the short term, it's not necessarily going to change the game in the short term. What you saw on Monday in the carnage in the semiconductors was things like healthcare and consumer stocks. They held up perfectly fine, so there's no obvious reason to suggest this should logically be the start of a major correction after what's been a fairly steep climb over the last year or two. But what you're likely to see is, as the barriers to entry into AI come down, you're likely to see more innovation and it becoming more effective for a much wider range of companies across the economy to either develop AI tools or take applications and apply them to their existing model to reduce costs, increase revenue, to grow earnings.
All right. So, if you're an investor, don't panic. Obviously, do you need to make subtle changes, though? Do you think?
I think what this episode has told us, it just reinforces the truism that a diversified portfolio of quality companies is the most appropriate way for investors to get exposure to the global equity market. Particularly if we're seeing a broadening out of the AI winners. Regarding semiconductor stocks, as I said, I think it's too early to come to a definite conclusion. If we're seeing greater efficiency in AI innovation, which may mean less computing power is required to develop large language models, that may still be a benefit if demand increases for the hyperscalers that run the data centers. Looking more broadly and probably more interesting, as I've touched on, I think the investors should actively look for high quality software businesses that are developing the AI applications that are going to help businesses to reduce costs, grow revenue over time. And beyond that, looking outside of technology, I think investors need to look carefully at how businesses are taking advantage of falling costs of AI to adapt them to their business models to improve their earnings growth.
And Tim, aside from what we're seeing on the corporate front, a big week as far as the macro moves of central banks. We've got a raft of central banks, including the Fed, the ECB, and then we look ahead, of course, to our own Reserve Bank off the back of inflation data. How mindful are you about what we're likely to see from the central banks and the movement of interest rates?
I think starting with the Fed. The Fed is established a well-trodden path of signalling to markets what it's going to do, and it would come as a great surprise if the Fed were to do anything this week. Over time, rates are likely to move lower before they move higher, but of course the extent of the cuts in interest rates are now much less certain, with a number of policy choices that the new US administration is likely to make are likely to be potentially more inflationary.
Tim Richardson from Pengana. So let's focus on our opening of the market here, just a couple of minutes away. SPI futures indicating a solid start. They're up more than 0.4%. We'll stay with us because the open is just a couple of minutes away.